Happy Wednesday, September 2nd. Welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets. All three of the major indices are up and rallying. We are seeing consistent consecutive closes that are record closes for both the S&P 500 and the NASDAQ, and the Dow Jones Industrial is up just a little bit over 1%. So, stock market continues to rally. People are still buying on the future of the recovery, and we are seeing that increase in the markets. Jumping on over to crude oil, we are seeing that come down a little bit from where we were actually a couple dollars a barrel from last week. So that is in the $41 barrel range, and we are seeing a bit of a tightening on the U.S. 10-year Treasury. That has come in to about 65 basis points. 0.65 is where that is trading today. That was 69.69 last week. Jumping on over to the multifamily interest rates, more continuing good news there as rates remain relatively flat, although FHA rates are slightly tighter than they were last week. So let's get into them. Going over to the 223F fixed permanent 35-year rate, looking at a 2.15, that is 215, fixed for 35 years. Jumping on over to the 221D for new construction sub-rehab loan, that is quoting at 275, 2.75, that is fixed for 40 years, if you can believe that. Very low interest rates there on FHA in our current market conditions. Going on over to the agency desks, we are seeing Fannie and Freddie at parity, at least in terms of their quoting on some of their, A-class properties. They're looking at the 295 to 315 range, and they're in parity, which is a little unusual. But again, Freddie Mac continues to be very competitive, and it's neck and neck, really to the end, to see who is going to deliver the best pricing over on those GSEs. Going over to other news, a couple things I want to speak about today. Read an article about the United States has exceeded our gross domestic product in terms of our debt. So in other words, we have more debt than we do of gross domestic product. Not the first country in the history of the world to have that happen, but that made some news that we were at that threshold. One analyst commented that we really should be looking at our debt to the projected GDP trajectory, because that is really obviously what pays on those future obligations is the trajectory of our GDP. But that was an interesting thing to note, and it made me think of something that I believe is very relevant to multifamily owners and borrowers in particular, and that is the concept of leverage. How much is too much? And another important question, does more leverage create more risk? Fair question. Now, when I think about that, I like to go back to my graduate school of banking days when you're, playing these games like you're running a bank and you're looking at risk, trying to manage an entire portfolio as a CEO of a small bank. One of the things you look at is the probability of loss versus the loss given default. Okay, probability of loss versus loss given default. Two very different concepts. Both do have to do with risk on your loans not being repaid. But the first one has to do with what is the risk of this loan not being paid back. That has a lot to do with how the loan is underwritten. It is the process that it goes through, the old 5 C's of credit, and the rigorous process or not so rigorous process that a lender may put a borrower through in order for them to qualify for the loan. That affects the probability of loss. Loss given default is really when the leverage comes into play. Loss given default is basically when things don't go very well at all, and someone who is the debtor has to take possession of the property and sell it, and of course there's a loss there, right? Because banks and lenders in general are not great asset owners. That is why you have investors always asking for that REO bank-owned property list, right? We know that banks aren't the greatest sellers in history, so we know we can get a pretty good deal on those bank REO properties. That is the loss given default. The two concepts are very different. Okay, for example, on the HUD FHA multifamily program, you do pursue more leverage. Borrowers in that program are allowed to lever up in general higher than they would on agency debt in a lot of cases, in a lot of different markets. they are able to also have their payments be lower and have better cash on cash returns because they have a very low interest rate with a very long amortization. The two combine together like Voltron to form an extremely low loan constant. That is what delivers you better cash flow, your after debt cash on cash returns, if you want to think of it that way. And that is an FHA loan, which does encourage that leverage. Now, a couple years ago, I heard the acting deputy director of the HUD FHA multifamily group say, out of a portfolio of 11,000 mortgages, $80 billion in debt, they had six that were 30 days past due. That's it. Are you kidding me? Any bank in the world would just kill to have that kind of, non-accrual or non-payment or 30-day past due. I mean, that is negligible. I mean, that is almost like a 0% risk of probability of loss. Okay, loss given default, different story. That's when you're selling the asset, how much debt is still on it. That's when you can really truly take that loss. Jumping over to GSEs. Now, GSEs work differently than HUD. They have shorter amortization periods. They have shorter loan terms. But how do they deliver this cash on cash return that multifamily investors are so focused on, right? For their investors and for their own returns. Well, they deliver that in the form of interest-only payments. So most agency loans carry some period of interest only. There's very few that use those programs that are borrowers that don't elect to have interest only. Why not? It's free money. You're getting better cash flow returns on your property, but you're only paying the interest on the mortgage. Which is more risky, right? That's up for you to decide, okay? Is it the leverage? Is it the interest only? If you recall, and you were around like I was in the last Great Recession, it was the interest only, and not only the interest only, but a very nasty little thing you don't hear people talk about anymore called negative amortization, when you were paying less than your interest payment and your loan balance was actually getting bigger, which was clearly the wrong way to go. But when you had that form of payment where you're paying less than the obligations, even less than the interest on the obligation, and you were over leveraged, of course, we all know how that turned out not very well. However, if it's a stabilized asset and it's strong cash flow, you could make the argument that interest only isn't that risky. But I did want to bring up the difference between leverage, because I feel that when I speak about leverage, sometimes leverage gets looked at as lower leverage just equals lower risk. And that is just simply not true. Okay, it might equal lower risk if you're just looking at a default scenario. It may be. But if you're thinking of probability of loss, lower leverage does not protect you from that. That comes down to the underwriting. That comes down to your business plan. That comes down to how you manage your properties and run your properties. And if you've got good leadership and good management, you are going to do very well in all kinds of different markets. So that is my thought of the day. Sorry it went a little bit long, but you can tell this is something I've been wanting to talk about for a while. So I'm glad it came up today. Thank you for tuning in to another exciting edition of Rate Desk. I am your host, Michael Thomas, signing off.